Hello. For some time now, Morningstar has maintained a list of companies its analysts regard as best businesses. Well, today I have with me Morningstar Head of Equities, Andrew Doherty, who's here to help us understand what makes a best business. Andrew, welcome.
Thanks, Nicole.
Andrew, tell us about the best business list. What's it all about?
Well, the best businesses are those companies we regard as the very best long-term investments. So we provide regular report updates where we're really encouraging investors to focus on the long term by investing in high-quality businesses that should provide decent returns without taking on too high a risk. So the best businesses really should hold up better than most during this downturn, and they're really positioned to flourish in times of stronger economic conditions.
So, speaking of performance, how have the shares gone recently?
So the best businesses have underperformed actually in the last 12 months. So looking at total return figures, total return is the capital growth and dividend payments. Total return for the best businesses is negative 10% in the last 12 months.
Should we be surprised by this?
Well, not so much really. The market has rallied strongly since March, in a market that's favoured cyclical stocks, and banks have performed very well as well. So these groups of companies haven't really been a part of the best business list.
Okay, so what about the longer term performance?
Well, the longer term performance is much more impressive. So over the last 5 years, for example, the total return of the best businesses is positive 16% per annum, and that compares to the market's 8% per annum growth. And really the performance has really been pushed up by the bull market that really ceased in December 2007. Also, though, we have taken out 4 businesses from the best business list in the last 18 months, so that these 4 businesses really weren't quite as robust as we previously have thought. But if we do include those 4 businesses in the total return figures, the returns are still quite strong. So in the last 12 months, the total return would have been negative 7%, so that's slightly better than the market. In the last 5 years, the total return would have been a positive 12% per annum, which is still comfortably ahead of the general market. And the point really is that these returns are generated without taking excessive risks. So the risks of the best businesses are far lower than the general market. And it flies in the face of the thought that many investors have, which is that you really need to take on a lot of risk to reap decent returns in the share market. But it's far better just to focus on companies which are performing well and likely to keep performing well for the foreseeable future.
So, Andrew, what characteristics are you looking for when you're considering a company to add to this list?
Yeah, well, importantly, we're looking for companies with sustainable competitive advantages. So these are companies with unique assets or skills that allow them to stay ahead of the competition and achieve strong levels of profitability or strong returns on capital for many, many years. So in our research process, we use the concept of economic moats very strongly. So we have a moat rating, wide, narrow or none, on each of the stocks that we cover. And each of the best businesses have a wide or a narrow moat ratings. So we want to see strong cost containment and revenue growth, stable and reliable revenues based on pricing power, so the ability to lift prices over time, maybe long-term customer contracts which will support more robust revenues, and popular products are important. Also, we want strong cash generation, so we want companies with high levels of profitability, so strong margins, and also limited requirement to invest much capital in the business just to keep it going. Importantly, also, we want strong balance sheets, so we don't want gearing to be too high.
Are companies in the best business list always rated a buy?
Well, no, I mean, it's one thing to find a great business, but it's another to pay the right price for it. So, any business can get overvalued at any time. So our analysts do spend a lot of time working out what an appropriate price to pay for each of the business is in order to achieve decent investment returns.
Do we have many in the buy zone now?
Well, there are 8 of the best businesses in the buy zone now, so really it is a great opportunity for long-term investors. Andrew,
are there any stocks that you'd like to highlight?
Yeah, one of the businesses we'd like to highlight is Brambles. That's one of the best businesses. Most of its earnings are from the CHEP pallet pooling business, and CHEP is the global leader in pallet pooling. Its revenues really are under pressure at the moment through the downturn, particularly in the US and Europe. But a large proportion of sales are in fast-moving consumable goods, which are less affected by the downturn. And there are longer-term growth prospects through increasing the penetration in existing markets and also extending to new markets. And this is a business that really benefits from economies of scale. So it has vast volumes that are pushed over a relatively fixed network, and so it benefits from increasing margins over time. It's a very strong cash generating business, so a very strong margins, operating margins of 36%, and this comfortably covers the fairly hefty capital requirements for the business. There is quite a bit of talk about a potential restructuring of the US business and also possible increased competition. There's a startup plastic pallet pooling business called IGPS, which has taken a couple of contracts off CHEP recently. But really being the incumbent has many benefits. It'll have options to respond to any competitive threats. And it really is very hard for any rivals to compete with CHEP's global scale and economies of scale.
Are there other stocks worth mentioning?
So Woolworths is a company that we often talk about as one of the very best in the country. It provides reliable and robust and very transparent earnings growth. And sales growth stems from the rolling out of new stores, refurbishing existing stores to boost the sales per square metre number, and also extending into related forms of retailing like liquor and petrol in recent years. It's very good at stripping costs out of the business, really benefiting from economies of scale. Very strong cash generation. It really benefits on a funding situation by its customers pay almost immediately over the counter or at the checkout, whereas it waits for 30 or 35 days to pay its suppliers on average. So it's really getting a funding boost there. So very strong business there and great prospects.
Thanks for your time, Andrew.
Thank you, Nicole.